Hey, what's up, guys? So, my name is Haya Fayaz. I'm an ACCA affiliate and a finance graduate, and my motive is to impart knowledge from my part regarding various finance topics, various ACCA related topics, and this is my second video. So, today I'm going to cover an advanced financial management topic, which is regarding derivative contracts, forward rate agreements, futures, options, this collars, and how we can use all of them to hedge against the rising interest rates on a loan amount of 34 million. So this question covers uh, the fact that the CEO is concerned about how much gain or loss do we get under each of the contracts of futures, options, collars, respectively, when we are using them to hedge against the rising interest rates. The interest rates are expected to increase by as much as 80 basis points in 5 months' time. Today is 1 June, and they are planning to borrow like in 5 months' time, the 34 million loan. So that's what it's all about. So let's start with the question. So based on the three hedging choices available to Daikon and the initial assumptions given above, drafter respond to the Chief Executive Officer request made in the first paragraph of the question. So let me check out the assumptions. These are just the rates and prices and stuff. Let me check out the assumptions. It can be assumed that settlement for both the futures and option contracts is at the end of the month. Okay, so basically it's among the months of March, June, September, and December. So in these months of every quarter, the settlement takes place, and that too, it's assumed that it's at the end of the each month. Basis diminishes to zero at a constant rate until the contract matures. Okay, and that means I'll explain you that time. And time intervals can be counted in months. Okay, that margin requirements may be ignored, and that if the options are in the money, they will be exercised at the end of the hedge instead of being sold. Okay, so that means till expiry we will keep them, and then we will exercise if they're in the money, so that we can gain the intrinsic value. So they are expecting to borrow 34 million in 5 months' time. That means if today is 1 June, by November, June, July, August, September, October. So after 5 months, that means 1 November, they are going to take up this loan. So, and then they can borrow at this much amount. This is the LIBOR rate. They expect that the interest rates may increase as much as 80 basis points in 5 months' time. Okay. So, based on current interest rate, the borrowing cost is how much? Is equal to 34 million. I'll just write like without the zeros into 3.6 plus the 70 basis points, because it's LIBOR plus 70 basis points. So 3.6 plus 0.7 is 4.3. So into 4.3%. Okay, and for a period of its amount, it will be fully repaid in 11 months' time, which means 11 minus 5. We are going to get the loan by 5 months. That means on 1 November. And after that, 11 months from today, it will be fully repaid. So that means 11 minus 5, that is 6. So the loan will be kept for a period of 6 months. So into 6 by 12. This is what we end up getting. And the increase in the borrowing cost. Increase in the borrowing cost is how much? So now the increase in borrowing cost, they are saying that they are it's being increased by 80 basis points in 5 months' time. That's expected. So currently our interest rate is 4.3%. So just simply add that 4.3 plus 0.8 for the basis points into the same 34 million into 6 by 12. As simple as that. So we end up getting 86,700. So 4.3, 0.8. Have I multiplied percentage? Yes. No. That's the problem. We need to make sure that we don't make such mistakes. So we can see there's an increase. How much do we want to offset against the gain? Or how much is our net increase in borrowing cost as a result of the increase in interest rates expected? That is $136,000. Okay, so this is what we want to hedge for. We want to hedge against this increase in interest rate. So first let's start with futures, because that's the first part of the question. 3-month December futures. Why December futures? Because whatever is nearest to this thing, the date when we go and take a loan. On 1 November, I'm taking the loan, as I already mentioned. In 5 months' time, we are taking. Today is 1 June. And I said we only trade in futures and all these types of contracts 4 times a year, every quarter. March, June, September, and December. So the nearest to the November 1, 2015, the date when I'm entering into a loan contract, the nearest to that is December. Right? So we need to choose December futures for settlement against this net increase in borrowing cost. Right? That is what the logic is. So how will I start? Let's first write futures. Future contracts, 3-month future contracts, current futures price is 95.84. Write it down fast. The amount is all in dollars. And then contract size. Okay, so the contract size, we need to find out how many contracts do we need to take, right? The formula is simple. It's just the 34 million loan that we are taking divided by 1 million, I mean, being the size of the contract, into the number of months we are going to take the loan for, divided by the futures period, the number of months the futures contract will be there. So we get 68. Next step, please follow these steps. It will be very simple for you if you follow these steps. So basis risk. So basis risk is nothing, just the difference between the futures price and the spot rate, the spot price. Whatever causes the difference between them is what is accommodated in the basis risk. And sometimes it's due to many changes in the market, or it could be uncontrollable changes, controllable changes, maybe like suppose if there are any outstanding amounts, like for example in this question I have entered the loan contract, I'm taking the loan on 1 November 2015, and I am only settling the futures on 31st December. So this 2 months difference that is occurring, that is what we have to account for in this, right? So what is the procedure? First I will go down and I will start 100 minus 3.6. 3.6 being the interest rate, the current interest rate on the loan as it's here. The LIBOR is currently 3.6. We are just taking that. This is the current market price, okay? And then simply find out the difference between this 96.4 and this 95.84. You got 0.56, right? So I will only accommodate, I will take 7 months time from today to December end, right? And I will accommodate the 2 months, that is November and December, when I was supposed to close the futures contract, settle the futures contract, and then net it off against loan. Technically, it's supposed to be in November, but as I said, it's only the settlement of futures contracts can only be possible on certain months of the year, every quarter, like March, June, September, and December. So for this particular one, it is December. So I'm going to settle it on December end only. So that 2 months, November and December, I'll have to accommodate in the basis risk. So which is why 7 months, 2 by 7 into this basis risk. I end up getting the unamortized basis risk at 1 November 2015. We have to calculate and keep simple. Then I have to find out what. Yes, now it will be easy for me to find out the expected futures price um, on the settlement date, that is December end, right? So is equal to 100 minus the increase. Okay, first of all, let me cover about that. Um, it's going to increase by 80 basis points. Clearly it's mentioned. So 0.8 plus 3.6. Okay, this is what we are going to consider. This LIBOR plus the 80 basis points increase. We're not going to consider the 70 basis points here. Please remember that. So 0.8 plus 3.6, 4.4. Now 100 minus 4.4 minus the basis risk, unamortized basis risk. So we end up getting 95.44 as our future price in the future. Okay, that's the answer. Now, yes, now the most important part. My rates are increasing. I am going to hedge against the increase in the borrowing rate. So I will make a short position in the futures market. I will sell now, buy later. Long position is buy now, sell later. But for this, I will sell now and buy later. Because simple logic is here. When you're expecting the interest rates to increase, that time your future prices will be lower, right? Your future prices in the future will be lower. So as a result, you can purchase them at those lower rates. It will be a gain for you. The logic is that, like, suppose now my rate is 5% and 5%, and now then in the future it became 7% because of the rise in interest rates and so on. So based on this 5%, I'll say 100 minus 95, 100 minus 5, 95. And based on the 7%, 100 minus 7, 97. That's my futures price. So, sorry, 100 minus 7 is my bad. 100 minus 7, 93. So my futures price fell down, right? It's a gain for me because I sold now at 95 and bought it in the future at 93, right? So I bought it at a lower price than how much I sold for. So this is what I'm talking about. When you go for an hedging purpose for this futures contract, sorry, for borrowing or the rise in the interest rates, that time you go for a shorter position in the futures market. So this is all about it. Then what do? Yeah, clearly I've got a gain. Why should I not accommodate it? I have locked myself into this contract. I have sold currently. I have sold at this price. My purchase price is lower. So well and good. That's a gain for me. So gain of 0.4. Then I want to find the total gain. So this 0.4 into number of contracts 68 into the tick value is 25 per contract. So tick value is as simple as that. So basically it means 680 into 1000. Actually, my bad. Wait. 68 into 0.4. Actually, no. Yeah, it's 0.4%. This gain, when we are subtracting these two futures amounts, we should write this in percent. Or you can write it as 40 basis points, whatever is convenient for you. So then I have removed all the zeros and calculated, which is why it has come like that. Into 1000. Okay, why is it coming wrong? Lol. 25. Where am I wrong? 0.4% is the gain into 68 into 25, and how am I supposed to do it? 40 basis points, or let me rather do 40 basis points. 40 basis points into this. Oh, without the zeros, of course. Yeah, now I get it correctly. So write it down as odd 40 basis points. So like I felt like there's something wrong, and that's how I corrected it. See, this thing about you know the percentage and the basis points, these all units, these are very important to take a note of. So it's good that I made this mistake so that you guys can also learn from it. So what is the answer? It's 40 into the contract number of contracts that we have entered into the 25, the tick value, right? That is my gain. And easily I can offset it against, my bad, easily I can offset it against the increase in the borrowing cost, minus 68,000. Sorry, my bad. It's 136,000. Yeah. So this is how it's the net borrowing cost after netting off, right? This is for my futures. Next, via option contracts. So how am I going to do it for that? Common size, contract size is 3 million, tick size 0.01, tick value 25. Option premiums are in annual percentage. So these are all in percentages. These are the strike prices given to me. So I'll just, again, I need to create a shorter position. So I will go for puts. Puts is December puts because, like at the, again, it has got certain times of the year, that is March, June, September, December for settlement, only these months. So December puts. Puts because I will sell now, buy later. That's creating a short position in the market. Short position. So we'll go for puts. There are two prices. We'll consider both of them. Remember that. So 95.5 and 96. Right? These are the exercise prices. I have to compare which will be more fruitful or which will create more gains for me. So I'll have to go for checking the amounts under both of these. So first, premium. These are the premiums for December puts, 0.304, 0.508. How do I find it? It's just simply put, my futures contract was 95.84 and the future price in the future is, how much did I find it as at that time? Yeah, 95.44. This is what I found as my future price in the future, right? Like the December end, this is what I'm going to get. Option contracts are always against our futures contract, okay? So that's why I'm taking the figure associated with the futures price on the settlement date, because I want to see if I will exercise my futures contract or I will go with my options contract, which is going to create benefits for me. I will just go for that basically. So both of these 95.44. Now I want to see on the maturity date, or at the end of the hedge. So it's saying, and that if the options are in the money, they will be exercised at the end of the hedge instead of being sold. When is the end of the hedge? December end, right? So which is why I'm considering the futures price at the end of the period, end of the settlement period. So it's 95.44, right? Futures price in the future. So for put option, just remember one thing. The logic is that if the market price or the futures price is lower than the exercise price, it will be preferable. It will be considered as in the money. And if it is higher than the exercise price, then clearly put option is not something that has created benefit for you, and you can opt to get out of the contract. Because in option contract, that's what the benefit is. That's what the advantage you have got. You don't have to get stuck into the contract. You can just opt out of it, but you still have to pay the premium, and you can enter into the market price if that's what turns out more beneficial for you. So what are my gains? This minus this, enter. Sorry, my bad. It's this minus this, enter. Similarly, we'll pass it on here. Gains, premium, the main point of concern. How much is it? 0.304, 0.508, 0.304, 0.508, 508. Oh, my typo does not work properly. 508. So got both of these. Now, these are my gains. I will have to net off my premium against this. Clearly, minus this. Okay, I'm getting a negative amount. This minus this, yes, it has turned positive for me. So I have now understood which is more fruitful for me. Let's find out in terms of number of contracts how much beneficial it will be. So 0.052 will be how many ticks? What do you think? It's basically 5.2 ticks because we just need to multiply by 100. That's it. 5.2 into the 25, the number of ticks. 25 is what is it, the value of tick, yeah. So 5.2 ticks, 25 being per tick value into number of contracts, 68. So we end up getting a gain of 8840 total gain, right? And this clearly I can say we are not going to go for this. I'm getting a net negative amount, amount netted off after premium. I'm getting a negative amount, so I won't go for this. Clearly I'll go for this one, the option with the put option with the strike price of 96. So netted off against the borrowing cost, how much would it be? Is equal to the total borrowing cost of, no, the net increase. We have to do it against a net increase. So this 130 into 1000, because it's I have eliminated the zeros above, as you can clearly see. This minus the 8840. So this is how much remains with me after I net off the gain. This is how much I would have to pay if I would opt for a option contract. Clearly I can see that under futures I'll have to pay lower after netting off the gain when compared to option contract. But let's go, let's move on. Let's see what does collar option give us. So collar, what do we do for that? Collar is just got one system, remember that. We buy a put option, this is the system, and we sell call. That's it. That's what you need to remember. Okay, so now it has to be at the lowest amount possible. You're buying a put option, right? You will choose not the one which has got higher option, of course, not the one where you have to pay more premiums. You'll have to go for the one where there is lower premium. So I'll go for 95.5 and 0.304 combination. 95.5 with a premium amount of 0.304. 0.304. And for call option, what would you do? Again, you would prefer a lower one, 96, and anyways you can't go for 95.5, so yeah, 96 and 0.223. 96 and 0.223, right? We are taking collar option. Usually it's preferred because it reduces the cost of any contract that involves options, because it can net off the premiums. I'll show you how. So this is the system that collar consists of. This is the exercise price, simple, 95.5, and this. Again, I'll take my futures price, 95.44, 95.44. What I did here, same I'm doing here. I want to see what is my futures price in the future. I want to compare it with this futures price in the future. It's called futures price, sorry. So I can see, as I already mentioned, put option. I can clearly see that the futures price is lower than the exercise price. So it's preferable for me. I will definitely exercise. Exercise or not, write it down. Make it clear for the examiner that you know it. And here, call option. Okay, so I don't have to exercise it. I'm going to send it to somebody else, right? Will anyways, 96 and 95.44. The exercise price is higher than the futures price, the market price, I mean. So clearly, it is not in the money. The person who will be buying the call option from us won't exercise it. So technically, it's a gain for us, right? And like, I can't say it's a gain, but then it won't be exercised because that person will just pay us the premium and that's it. He'll go for the market rates instead. So therefore our gain will not be minimized or anything. Let's just not go to the technical details. We'll just say no, it won't be exercised because clearly the exercise price is higher than the market price, futures market price in the future. So it is not in the money, it won't be preferred. And at the same time, it's the opposite for put option. So yes, I will exercise it. How much is the gain? This minus this. Enter. And here no gains are required because it won't be exercised only. And is equal to, yes, first I will subtract and check whether it will go to a negative amount. Net premium is what I will find first, because I'm going to have to pay this much, but at the same time I'll also get this much from the buyer of the call option, so I'll have to net them off first. This minus this. Enter. 0.081. Okay, this is the net premium that I'll have to pay. Now I'll check this minus this. Enter. Okay, I'm getting a negative amount. That's sad, isn't it? So yeah, I'm getting a negative amount, and clearly it's going to increase my borrowing cost. So yeah, let's write increase in borrowing cost. So clearly it's not in our favor. This is equal to 2.1 basis points. You just have to multiply into 100. That's it. 2.1, but negative 2.1 because it's a loss. 2.1 into 25 being the tick value per tick, and 68 being the number of contracts that we are entering into. So I got minus 3570 as my total cost. So total cost under collar, and then total increase in the borrowing cost. No, total borrowing cost under collar is therefore equal to our this into 1000. As I said, I have not accumulated the zeros in this. That's why I'm multiplying by 1000. Then this plus 3570 because it's an increase in the borrowing cost. Borrowing cost is already a loss for the firm, so like increase in the loss is supposed to be added. If it would be a gain, then it would have been deducted against the borrowing cost, right? It would have been reduced against it, but it's not a gain, it's a loss. It will increase the borrowing cost for us. So 139570 is what I get. So clearly, just please darken it a bit. Let's just bold it. I mean, yeah. So clearly I can see that I've got the lowest in futures contract, and you can write in the answer that you would prefer this because it's financially it's more beneficial for the firm, but we should probably consider other factors like options having the flexibility of switching to market rates in case if the market rates actually do not rise, the borrowing costs don't increase, then we can like opt out of the contract. But at the same time, options are costlier than futures also because options have got premiums, all of that, while futures don't really have that. But in futures contract you will have to consider paying the initial margins, maintaining some amounts of funds as per the authorities, stock market, sorry, whatever market, futures market, you need to maintain some margins, so that is also something that has to be considered. And collar also provides some sort of flexibility, like in case if your interest rates actually do not rise, then you can let the put option expire, not utilize it, and just take the benefit of the gains happening in the market, the interest rates in the market. And yeah, that's pretty much it. Although I would say in that situation, your gains will only be limited to the call option prices. Let's not go to the technical details, you don't have to mention so much, but your gains will be limited in this because of entering into the collar contract, while in options contract your gains won't technically be limited. Yeah, you can simply go and enjoy the whatever price is there in the market. So that's all about the first part of the question. We have successfully completed that. Now part 2, let's check out. So part 2 says that we have enter into futures contract on 1 June. 30 futures contract is sold on 3 June at this price. And this is for December futures, 4 days. So like just keep talking about it. Keep finding out the gains against the settlement prices on each day. So first of all, 95.84. This is the price at which we had bought it, 95.84, right? Initial price 95.84. Then afterwards we reduce it. No, sorry, what am I saying? Afterwards the price is reduced to 95.76. That means at the time when I'll have to sell it, it will be 95.76. So it's a loss for me, right? Second June price is like 95.76 minus 95.84, right? So it's a loss. And no, just edit the writings. I'm just writing it like very quickly, that's why I'm making mistakes. Based on 2nd June price, the loss, the total loss. If you want, you can express it in basis points. So it's equal to 8 basis points into negative 8 basis points, of course, because it's a loss, into 25 being the tick value, and into 68 contracts. No, my bad. They entered into 50 contracts, right? So 50 contracts. So minus 10,000 is a loss on that day. Then afterwards, based on 3rd June price. So again, as we can see, on 3rd June we had sold some contracts. So at 95.61, while the rate was 95.66. So again, we have sold it at a loss, right? Is equal to 95.61 minus 95.66 into no, not into, this is a loss. Now this into minus 5 basis points into 25 into 30 contracts, because only 30 was sold, right? 3750. Remaining 20 contracts, what's the situation? So for them, we had bought at 95.76, sold at 95.66. Again, it's a loss for us of like 0.1 basis points. So 95.66 minus 95.76, so is equal to minus 10, because multiply by 100, right? So 10 basis points into 25 into 20, because it's only 20 contracts, or into 20. So minus 5,000. Now on 4th June, I expect there's some gain. Okay, yeah, there's a gain. We bought at 95.66, sold at 95.74, and it's only 20 contracts that is left with us, because 30 was sold, as you can see. So 30 were sold. 20, no, first 95.74 minus 95.66, 74 minus 95.66 into, no, not into, sorry, it's again, yay, 8 basis points. So 8 into 25 into 20, and there we go. This is our total losses and gains on each of the days from 2nd to 4th June, like that. Next, they are addressing the concern Daikon will need to deposit funds into a margin account with a broker for each contract they have opened, and the margin will need to be adjusted when the contracts are marked to market daily. Yes, so basically, as I mentioned already, in the futures contract, you'll have to open a margin account. You have to maintain initial funds in that. Okay, it should never be zero. Okay, otherwise you will be called out. and maybe your futures contract can even get cancelled. So and secondly, you will have to fill some amount of funds, and if you have got profits, it will be added to your account and you can just take them, you can take out the surplus from your account. If you have got losses, of course it will be decreased from your account, and if it comes to a point where your uh, limit or your margin is not met, then you will be called out to fill the fill your futures account with some, fill your margin account with the initial margin at least, right? That's the whole point about it. Then it's unlikely that option contracts will be exercised at the end of the hedge period unless they have reached expiry. Instead, they more likely be sold and the positions closed. Yeah, so basically, this is a simple concept. When you are selling it before its expiry, the option contracts, you tend to, if they are in the money, if they are in favor of you, if they are in favor against the market rates also, then you will gain an intrinsic value, right? That is for sure there. At the same time, if you're selling it a bit before the expiry date or long before the expiry date actually, then you will gain that time value of money. That time value of money, which is very important, right? You will gain it before, if there's a lot of time till the expiry, then you will gain it. And summing up both of them, you will gain a very high value if you will sell them before expiry. But at the same time, if you are not, if you're waiting till expiry and you are you're just having the intrinsic value in short. But if you're not waiting till expiry, then the higher the time up to expiry, the longer the time up to expiry, the more your time value of money increases, and your gains coming up from selling your option contract increases. So it's more likely that you will sell and close your position much before the expiry date. That's more preferable. That's pretty much it.